This is Sammy Fumagalli, and I will be talking about my capital budgeting that I did. This is year 2014. I did the New Heritage Doll Company. So this is kind of just like a financial snapshot of it all. My company APV was 437.27, which you see right here, which the higher the number it is, the better it would be. I would say that mine isn't the lowest it could be, but it definitely could be a lot higher. The doll houses with miniature dolls, it said it launched successfully, but with somewhat lower margins than expected, so it could have been a little better. So basically this is showing the revenue, the operation income, net income, and then this down here is kind of showing us our production, our retail, and our licensing. And so basically retail was mostly higher, and then production, and then licensing. Then if we look, you can see here's our operating and our total assets by division. If we go to the income statement and the balance sheet, so basically this is just a profit and loss statement dealing with all of our revenues and expenses. You can see the net income right here is 23.34 in 2014, and it increases. It goes down a little bit right here, and then it just continues to increase, which is good. Here you can see the balance sheet with our assets and our liabilities, and then our total liabilities and stockholders' equity, which, as you see, like, everything is increasing, which is good. We can look at production. Again, we see our net income was 4.93, and as we go through the years, it is increasing. Here's our assets and our liabilities again. And then we can look at our retail. And again, our income statement, our net income is increasing. Our total net assets is increasing. Total current liabilities is increasing. And then our total liabilities and stockholders' equity is also increasing. And then lastly, we look at licensing. And you can kind of just see the net income here, the balance sheet. Then we will go over to our cash flow statement. Now our cash flow statement is kind of showing us how changes in the balance sheet, accounts, and income affect our cash. It breaks down to operating, investing, and financing activities. So operating, so that's going to be more of like the cash that we have, and then financing and investing, which you see here and here, those are the money that we're getting from other people. So it's the most important we need to look at is our operations, which, as you can see, it did increase as we went down throughout the years, which is good. And so you want your total cash flow, which is right here, and this is a positive number, which that's good because that means you made money, and so that way you have money to buy things with now. Now we can look at our financial analysis, and then here we can kind of see this shows our debit-free cash flow. It's also increasing. Our discount factor. You can see the present value, and then like our 5-year cumulative. And then project details. This is kind of what my project was, lifetime project cost. The year selected I did was 2009. My net present value is 7.15. And then you can kind of see where the discount is, which is 7.70%. My payback period, which is a little higher, but it's not, it could be a lot worse. And then this kind of just shows us through 2015 through 2020, and again the payback period, profitability, and 5-year cumulative. And then if we look here, this shows us our net sales, our gross profit, earnings before income tax, our net income. And so now taking it back to where my dashboard is. So basically I just looked at different competing investments to make my decisions on what I thought, would have the best outcome. So this one is the dollhouses with miniature dolls, but so basically we were just looking at all different projects to see which one would have the best outcome for the future. Over the 5-year period, I had to make the best financial decisions that I could make. I looked for investments with definite growth options and that would benefit me in the future. I paid attention to the net present value, the IRR, and the payback. I made sure the NPV was higher, because the higher the better, and the payback period was lower, which is always good because you don't want it to be too long. And the money coming in at the end was positive because we don't want it to be negative, because then you're losing money instead of gaining money. So basically, another deal with this is capital budgeting. So capital budgeting is basically, it's like a step-by-step, process that a business uses so that they can determine the merits of an investment project. We look at it to see whether to accept or deny an investment project. So that was kind of this whole project was looking at the different options that we had and deciding, okay, which one's going to benefit me in the future. So that's basically to accept or deny an investment project as part of companies' growth initiatives and their, rate of return. It also basically creates accountability. If you're trying to invest, your resources in a project without understanding the risk and returns involved, you will be held responsible in the end. So basically, this is what I picked. I think my company APV wasn't terrible, but it could have been a little higher. But after looking at, my revenue by division, I thought it seemed okay. It could have been a little better, but even reading the project updates, it launched successfully but with somewhat lower margins than expected, attribute to higher production and marketing costs. So I still think that, even looking right here, the revenue from 2009 to current grew. The operation income was 22.60, and it also grew. And then if you look at the net income, it also grew as well. So I think in general, I did a pretty good job and I learned a little bit from it. So this is my capital budgeting finance simulation. Thank you.